Well, as an economist rather than an accountant, I was wondering why I've been invited here. But in the last couple of speeches, I've realized that actually there's a question that has been running through pretty much everything that we've discussed in the last 2 days. And that is, why has there been no reform, given that the arguments for reform are so overwhelming? And I think actually the answer is surprisingly simple, at least in the case of Europe. The reason there's been no reform is because the EU has rules. It's a rule-governed institution. It exists largely for the rules, and the rules are set by economists and interpreted by lawyers. And what you've got to understand is that economists are not very interested in facts. They prefer to argue about theories and ideologies. Economists, and I think there's only one left, this is why I can, in the audience, and I can afford to be quite bold, economists are not really technicians like accountants. They're more of a priesthood. They're more like the astrologers of old, and therefore they have a great prestige among the governments whom this priesthood advise. So to change the rules, especially in a rule-governed and essentially non-political entity like the European Union, you have to change the economic theories, or if you like, the economic ideologies that are behind these rules. Keynes said back in 1936 in the General Theory, when he was reacting to the previous crisis of capitalism that occurred, the previous Great Depression in the 1930s, he said, the ideas of economists, both when they're right and when they're wrong, are more powerful than generally understood. Practical men who believe themselves quite exempt to any intellectual influence are usually the slaves of some defunct economist. And that is precisely, I think, what is going on in Europe and the rules of the Maastricht Treaty today. The Maastricht Treaty was negotiated in 1989, which was at the peak of enthusiasm for the monetarist counter-revolution, which had begun 15 or 20 years before that. The main message of that counter-revolution was that monetary policy and central banking had one and one only objective, and that was to control inflation. And the main point of the political structures that were created in the late 80s and early 90s around central banking was to insulate monetary policy both from politics and from any concern about stimulating or managing demand, economic growth, and employment. And that's why the rules of the Maastricht Treaty were what they are, and I'm going to come back to that in slightly more detail. Having said that, I think we should be very optimistic about changing these rules. Why? Well, largely because economics, like the EU, is forged by crises, and it's transformed by crises. And this is what I think we are now in the course of today. What I'm going to do in the 10 minutes or so I have available left to me is I'll talk for 5 minutes about why I think what are these crises, and why I think we are in the midst of a major change in economic ideology and political economy, and secondly, narrow down specifically what I think that will mean for the EU, and particularly some of the issues we've described. So 6 years ago, I wrote a book called Capitalism 4.0, which was about what I believed post-crisis to be a new model of political economy evolving. I'm not going to describe that in any detail at all. You can read essentially why the book is called Capitalism 4.0 and what the main gist of it in that one slide. If you want a little bit more detail, you can read the 2 articles, one from the OECD Observer and the other which was 5 years ago, and another which was published just a month ago in a number of newspapers around the world, drawing the political implications. But essentially, my argument, and this is going back through 150, 200 years of the history of capitalism since it really started in 1776, 1776 was an interesting year because it was, of course, the year of the Declaration of Independence in the US, the first self-consciously bourgeois capitalist society. It was also the year in which Adam Smith published The Wealth of Nations. So I think that's a good date to start the history of pre-capitalism, if you like. And my view is that, and I think this is not a view, it's more or less historical fact, that that history has gone through 3 or 4 crises. The question is whether the last crisis in 2007-14 was of a systemic nature, powerful enough, as powerful as the other 3 that I've mentioned, to transform the way that capitalism is done and the thinking behind it, both economic and political. I believed when I wrote that book 5 years ago that there would be a lag of 5, 6, 7 years, as there was in the 60s and 70s, as there was in the 20s and 30s, before economic thinking began to change and follow the breakdown of the previous model. I think that's what we're beginning to see now, and I think we're seeing the political implications with some of the populism that we've talked about, which in many ways is quite reminiscent of what happened in the 1970s and the 1930s before that, and arguably going right back to the mid-19th century, the so-called Year of Revolutions in 1848, when Marx and Engels wrote the Communist Manifesto. But that's enough of history. What does this mean in practice? What is the evidence, first of all, that some of these rules are already changing? And I'll focus on one piece of evidence in particular, which is perhaps the most fundamental issue of economics, as I've just mentioned before. What is the purpose of central banking? What is the purpose of monetary policy? For the over the last 40 years or so, since the monetary counter-revolution, as I said, there's been a very clear answer. The purpose of monetary policy is to keep inflation down, is to keep inflation under control. I think it's very clear that that objective has now changed not just a little, but by 180 degrees. And the evidence of it, I think, is illustrated in this chart, which shows the relationship between interest rates, the blue line, and inflation, the red line, in the United States since 1970. And what you can see is that until 2008, the blue line was consistently above the red line. In other words, the central bank was constantly trying to squeeze inflation downwards. And that's what developed the idea that it is the role of central banks always to, the phrase in the market that's often used in the markets, is to stay ahead of the curve of inflation. And there is still a very strong belief among financial analysts that pretty soon, sometime in the next 2, 3, 4 years, interest rates are going to have to rise significantly all over the world because inflation will creep up, and central banks, as soon as they see inflation creep up, will want to get ahead of that curve of rising inflation to prevent it accelerating. I believe completely the opposite. The lesson of the last 40 years is that central banks do not stay ahead of inflation. It's the essence of central banking to be behind the curve. That's what Paul Volcker taught them. But it was, from 1980 onwards, they were behind the curve of falling inflation. Every time inflation fell, the central bank kept interest rates higher than they needed to be to ensure that inflation came down. They buried the inflation 6 feet under and then put a stake through its heart so that it could never rise again. That was the purpose of central banking from the late 70s until 2007. What you observe in that chart is the red lines and blue lines flipping over in 2007-8. The purpose of central banking today, and you don't have to take it from me, just listen to Mr. Kuroda from Japan or even Janet Yellen here. The purpose of central banking today is not to get inflation down and keep it down and put its stake through its heart. It's to get inflation up, keep it up, and make sure that inflation never again, at least in our lifetimes, falls below 2%. Now that means that the whole function and the whole way the central bank has behaved has completely changed. I think we can observe that. Very few economists yet recognize this because, as I said earlier, they're really not interested in facts, they're interested in theories. This is just one very clear, quick illustration, and then I'll go on to the specifics of Europe. What was the economic theory behind the divorce of central banking from politics and the isolation of monetary policy purely to dealing with inflation. It was an idea that Milton Friedman developed from an economist, a British, actually New Zealand economist in the 1950s called Phillips. It was the Phillips curve, the relationship between inflation and unemployment. Phillips believed that there was a sort of curved inflation, that there was a curved relationship, so that if you were willing to tolerate a little more inflation, you could get a little less unemployment. So there was a trade-off between inflation and unemployment. Milton Friedman alleged that there was no such trade-off, that the Phillips curve was vertical. In other words, that if you tried to push unemployment just a little bit below what he called the natural rate or non-accelerating inflation rate, NIRU, of unemployment, if you tried to push unemployment below this natural rate, you would get ever-accelerating inflation, a vertical Phillips curve. And indeed, there was some empirical evidence of that. That was the NIRU for the United Kingdom in the late 60s and 1970s, a vertical Phillips curve. That over there is the Phillips curve from 1991 to 2009. Is that vertical? No, it's horizontal. Did any economists pay any attention to that until 2007? No. That horizontal Phillips curve indicates that central bankers should not be in the business of merely focusing on inflation. That actually showed that it almost didn't matter what central bankers did. Inflation stayed the same, and the main impact of monetary policy was actually on unemployment, precisely the opposite of the effect predicted by standard economics. But as I said, nobody paid attention to that until the world was hit by the 2007-8 financial crisis. Even now, of course, there are far more sophisticated versions of this Phillips curve theory. There have been all sorts of Ptolemaic circles that have been built onto this theory to make it appear consistent with before the leap to Newtonian or Copernican economics, if you like. But the fact is that the central bankers, the policymakers, have already begun, over the last 5 years, to move away from the theory represented by the facts on the left towards the theory on the right. Now, what relevance does all this have to what we've been talking about and what's going on in Europe? Because I think the reason for hope is that although the Maastricht Treaty rules have not formally changed, the application of them has been completely transformed, and not by any of the discussions that we've had so far about fiscal six-packs and so on and so forth, but by what Mario Draghi has been doing at the European Central Bank. So let me now, in the last 5 minutes, just talk about what I think is going on in Europe with monetary policy and how it relates to these fiscal rules. At the height of the euro crisis in 2011 and 12, it was generally agreed, as Jörg Asmussen said, that there was an existential crisis of the euro, and we've had various different descriptions of it. This is the way that I thought about it in 2011-12, and I think these are still the issues that are relevant, that are relevant to it. It became apparent, as a number of speakers have just told us, that the euro as constructed in 1989 was an incomplete system, as Nicolas Venon said. But the precise nature of the incompleteness didn't become clear until the euro crisis hit in 2010 and 11, and with Greece specifically. And at that point, it became clear that, as a number of people said, the European borrowers are not sovereigns, they're sub-sovereigns, and you had a relationship between a very, very powerful central bank with complete monetary authority and no proper fiscal counterpart on the one hand, but on the other hand, you had a relationship between fiscal authorities who could not rely on the support of the central bank in the way that the American, the British, Japanese, other governments, who actually had much more insolvent financial systems than the Europeans did, but who were able to resolve the crisis because there was this perfect match between the fiscal and monetary authorities. So what it became clear was that in order to survive through a crisis, you needed three types of union. A genuine monetary union, which meant that you had to have a central bank that could act as lender of last resort, both to banks and in extremis to governments, which you didn't have because of the Maastricht Treaty forbade monetization of public debt. You needed a fiscal union, which involved not just what the fiscal compact said, which was joint oversight of fiscal policies, but also a degree of mutual support among the borrowers, because no government would accept oversight of fiscal policies without a degree of mutualization of the responsibility for those debts. That, again, was ruled out by the Maastricht Treaty, the so-called no bailout clause, the no mutualization clause. And of course, to make all that legitimate, you needed some degree of political union. But it was really the absence of the monetization power of that the Fed had, the Bank of England had, the Bank of Japan had, to lend to governments and banks on the one hand, and the absence of the mutualization, which would have enabled the strong credits to support the weak credits, that really was the core of the euro crisis, and that led to genuine and I think very legitimate questions about whether the euro could survive. My contention in the last few minutes is that those questions have now been definitively resolved. And they have not been resolved by any change in legislation. They've been resolved by the actions of the European Central Bank since Mario Draghi took it over from Jean-Claude Trichet. The illustration of that is in this chart. What this represents is the size of the QE program, the bond buying program, that various central banks have conducted under QE. As you know, the ECB refused to undertake quantitative easing until the beginning of last year, largely because of German resistance to the idea of the central bank explicitly buying large volumes of government bonds. On January 22nd last year, Mario Draghi announced an incredible breakthrough that I don't think he himself, and certainly nobody in the market, fully expected, and even today I think the scale of it is not recognized. What he revealed was not only that he had got German approval, or at least acquiescence to quantitative easing, but that he had got acquiescence to QE on a scale far greater than any other central bank in the world. The relevant comparison, I think, for the amount of bonds that the ECB is buying is not the size of the European economy, but the flows through the relevant bond market. What share of the new issuance of government debt is the ECB buying as compared with other central banks? And that's what this chart illustrates. The ECB is the blue bar on the right. The ECB is now buying 250% of the total net issuance of all government debt in the Eurozone, with the significant, so far, exception of Greece, which I'll come back to right at the end. But all other governments are now selling their entire net issuance of debt, and on top of that, the ECB is buying the equivalent of 150% of net issuance out of the outstanding debt stock. By comparison, the little red bar on the left is the Fed's QE3 program. At the height of the QE3 program, they were buying 50% of the US Treasury's net issuance. Now, you might say, why that enormous disparity? Because actually the dollar sums are about the same. The ECB was buying 60 billion euros a month. The Fed was buying 85 billion. Well, that's because in the Eurozone, government deficits had already been reduced to only 2.5% of GDP when the QE program started. In the US, government deficits were still running at 5.5% when the Fed started QE3. On top of that, the Fed was spending half its money on buying mortgage bonds. They were financing the entire US housing market on top of half of the Treasury. So what the ECB is doing is enormous in quantity, but even more importantly, is the size of it had a qualitative effect which was completely different from QE everywhere else. By buying 250% of net public debt, what was it doing? It was effectively monetizing the entire deficit of every Eurozone country with the exception of Greece. On top of that, it was effectively mutualizing a significant proportion of the outstanding debt stock by taking it out of the private markets and putting it into a mutually guaranteed European institution. And when I use those words monetizing and mutualizing, you can see the relationship to what I was saying earlier about the existential crisis of the Eurozone. Effectively, Draghi, through this QE program, found a way of circumventing the prohibitions against both the mutualization and monetization of debt, thereby resolving, at least while this QE program was going, these existential crises of the euro. What that meant, and what I think it still means, is that actually in Europe you have a much more powerful transmission channel from quantitative easing, from monetary policy into the real economy than we've seen in America or Japan and Britain. Not just because of the size of the program, but because the ECB has solved a problem in Europe which the Fed and the Bank of England and the Bank of Japan were not able to solve in their economies. Why weren't they able to solve it? Because they didn't have the problem in the first place. It solved the problem of a euro breakup, and it solved the fragmentation of the banking system between North and South. And therefore, it's, as I say, created a much more direct transmission channel into the real economy, and we've begun to see the effects of that already in European economic figures. This is my last two slides, then I'll sit down. That's credit conditions in the Eurozone as a whole, an average of demand and supply. As you see, from 2014 onwards, they were rising. By the beginning of this year, they were at the same level as 2007 before the crisis. Complete convergence of private sector as well as public sector interest rates there on the right, with the significant exception, of course, of Greece so far, and also temporarily perhaps Portugal. That had an immediate impact or a very rapid impact on real economies. In Italy, consumer confidence at the beginning of this year had reached a level that it had never before attained, except for about 2 months, in the previous 20 years. Consumer confidence at the beginning of this year was practically at all-time highs in Italy, having been at all-time lows only a year and a half earlier. It's corrected somewhat since then. And this last chart here shows the so-called economic surprise index, the degree to which economic figures are better or worse than expected. The black line is the Eurozone, the red line is the United States over the last year and a half. And as you can see again, at end of January, the black line suddenly whizzes up. And from that point on, the Eurozone economic surprise index has been consistently above the US for the last year and a half. In the first quarter of this year, the Eurozone recorded 2.4% annualized growth, as opposed to only 0.5% annualized growth in the US. Now, I'm not saying that the Eurozone is going to be in a boom or anything is great, but the conditions have dramatically improved, which leads me to the final point. If Greece is soon to be incorporated in the ECB's quantitative easing program, which I think it will be as soon as the negotiations that we've been discussing all this in the last 2 days are completed, Greece will very rapidly, judging by the experience of the other countries, will very rapidly benefit from a similar effect to what we've seen in Italy, Spain, and until recently, until the government breakdown in Portugal over the last year and a half. And I think we will begin to see the convergence of bond yields, the recognition of the true fiscal situation that we've talking about, and that's why I'm reasonably hopeful. Thank you very much.